Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, February 2, 2016. Here's a daily chart of the SPY, or the spiders, which mirror images the S&P 500. And we had a pretty good thumping today in the market. So the S&P was down about 36 points, which puts the SPY down about 1.8%, give or take. And interestingly enough, the level, I've got some other lines on the chart here that I'm going to talk about in a second, but the number we hit yesterday at 194.41, our high yesterday was 194.58, so we pierced through that a little bit, but that provided a pretty good level of resistance. And we've been discussing the fact that I thought that area, 194.41 to 195, would be a mountain of resistance, and so far that proved true. However, that doesn't mean that the market's rolling over from here and it's going to go back down. It could, of course, but I don't believe that's the case. So yesterday I thought we would have a pullback, and I put this green line in at 192.75, but we hopped right over that today like it wasn't even there. So that's obviously a non-issue at this point. It's gone. So the other lines I have in here are basically where I see the potential for the downside before an ensuing move higher again. So 187.80 and 186.20. What I'm telling you here is that I believe the market could actually pull back that much and still remain in a position to go higher before the next real move lower gets underway in earnest. I don't know that we get down to those levels. I find it a little bit out there, although that's what the math tells me. And so I'm going with the mathematics, and these are the numbers that the calculator came up with. 187.80 and 186.20, and we could still be in a position to move higher, even if we hit those levels. Could we just resume the up move tomorrow? We could, sure. But, there's no telling what tomorrow brings. It's a little bit up in the air. This is, folks, what a bear market is. A bear market represents big swings in both directions, big intraday swings, and big daily swings. And like we were talking about from the lows, we had 150 point rally in the S&P off the lows from low to high. And now all of a sudden from yesterday's high, we find ourselves down 50 handles from yesterday's high till today's low. The market was up about 50 handles on Friday. This is what a bear market looks like. We're in a bear market. That doesn't mean we can't see rallies, and we will and we do. But this is what a bear market looks like. So I still am in the camp that there's one more move higher before we roll over in earnest and make new lows. And when I say one more move, it's not one more day. It's another move higher past the 194.41 area that we were at yesterday. So whether it's 197.56 up in this zone, or even up to the 201 area up in this zone or higher, I still think that that's the probable scenario. The market is designed, and I've told you this a number of times, and you have to remember this. The market is designed to make as many people look like fools as possible. That's the way it works. So right now, you're getting a lot of bearish sentiment again. You're getting a lot of what was the reason for the move down today? It was the banks, it's oil, it's this, it's that. So they come out of the woodwork with every reason under the sun. And if the market happens to be up tomorrow, nobody remembers that it was down today. That's just the way it works. So in my book, this market is not finished going higher. We need to get more bulls on board. We need to get more short covering. We need to get everybody believing that the downside is over before the downside could begin again. Okay, so yesterday was good. We hit the 194.41, slightly higher, rolled over a little more than I expected today, but that's the the way the market is, right? You just, from day to day, you're never 100% sure what's exactly going to happen and how much it's going to move. And in these bear market bounces and bear market sell-offs, you need to anticipate that the market's probably going to move more than the norm, okay? So where's the positive out of today? Well, the market closed today at 190.16. That's the spider. The close was 190.16. The low from Friday was 189.88. That's a positive in that we've closed above the low from Friday, which is this big up day here, okay? That's a positive sign. It doesn't mean we can't go lower tomorrow, but that's a positive sign. And by the way, now you understand, and we didn't know this until after the fact. I get it. It's Monday morning quarterback. But now you understand why I unloaded SSO yesterday, even though I believe the market has higher prices in the future, in the near term, before it goes lower in earnest. It hit my second target. When you have that opportunity, you take the money and run. You never know what tomorrow brings. We can discuss probabilities. We can discuss mathematics. A lot of times the market will hit the numbers or close to it that I identify. But when you have a position that you have a profit on and you're in the money and you have a second target that you identified a week earlier and it hits that second target, you take the money and you run. That's just the way it works. Most of the time, you're going to win that way. Sometimes the market will continue higher, but you wouldn't have lost anything. You just lost out on an opportunity, but you can't look at it like that. You can never look at the market as if, how much money can I make, or how much money didn't I make, or how much did I lose? The idea, for me at least, is I want to be right. The money will follow if I'm right. It's a mechanical business. And I had this discussion via email with one of the members today that when you take a trade, it's mechanical. And you have to look at it as it's just numbers. If a stop gets hit, you're out. If a target gets hit, you're out. You have to look at it as just numbers on a chart, not the money involved. And I understand it's difficult, but that's the way this business works. That's the way you can be most successful, is by just looking at it as a numbers game and not thinking about the money involved. Once you start letting the emotions and the psychology of the monetary aspect take over, that's when we start to get ourselves into trouble. So that's the end of my soapbox for tonight. Okay. Let's go over to the IWM. And the IWM got thumped pretty good today, also down over 2%. But it's the same routine as the spiders. The low from Friday was 99.96, and the close today was 100.28. So it's in the same position as the spiders are in. Now, if we close below that level tomorrow, okay, then those other numbers that I identified in the spider come into play, and there are, of course, corresponding numbers on the IWM. And since I'm the one that brought it up, I might as well have done the calculations and put the lines in for you, and that's exactly what I did. So we have 99.08, 98.13, pardon me, are the corresponding numbers that I mentioned in the spider for the IWM. On the downside, should we go down further, it still would only be a pullback unless we broke the lower level, then something else is developing. And I still believe that there's higher prices coming in these markets before we roll over in earnest. Same story, just translated the mathematics over to the IWM. The transports also got really hammered today, down almost 3%. And you can see here, we never did make it to the underside of the downsloping trend line. And for the newer folks, where does this trend line come from? It comes from the weekly chart. And it's been here on my charts for literally months. And the market has respected this downsloping trend line a number or numerous times. And that's how we know that the market thinks that that price level or that trend line is of importance. Each and every time it gets below it, it rallies back to it, it pops back over it, it comes back to test it, it plays around with that line. and now we're below the line, and we closed the week below the line, and well, we closed several weeks below the line now, but that's bearish. But that's not to say we can't rally back to the line. That's why I keep it in there. It's very important. The green line, for the newer members, is a level we put in once this line broke a few weeks back. I put in the line at 65.60, and I said, well, here's the level that we can get to, but I don't expect it to happen right away. And then it happened right away. So, I put the lower level in as well, and that will be expected to be hit on the transports, the 57.25. I expect that level to be hit the next time the market cracks and goes lower and breaks the lows. So that's just a little history of the transports for the folks that weren't around back when all that was taking place in January. Okay, so let's go to gold. The gold market was basically flat today, really didn't do much. We may have to stall out here, put in some more consolidation. We'll see. It was a little interesting, I thought, that since the gold market had been of recent inversely related to the stock market, meaning each and every time of late the stock market went down, gold went up, and then they call it the fear trade, and you know how that works. But what happened was, today the market got hammered pretty good, and gold didn't do anything. So what that tells me is we're pretty much at a level where we probably have to consolidate for a while. We're in an uptrend. Nothing's changed. Even if the market pulls back a little bit, the uptrend remains intact. You know, these lines that you see on the chart were lines that we've had in here for quite some time, and they've proved very, very helpful to the folks that have been around here for a while. So I leave them in. We don't really need the lower lines anymore, but we leave them in because they're helpful as a guide, as a roadmap on how we trade in the gold market. And so the 1110 was very, very important. You see how we hit it, backed off, went right back to the 1075, and then popped back to the 1110, finally broke through it and went right to the next level, which is 11.25. The following level we have is 1135. We got to 1131.40 today and backed off a little bit. So the 200 period moving average and the 1135, which is a mathematical number, is providing a level of resistance, or will provide a level of resistance. However, 1145 and 1167, in my book, through my calculations and my work, I'm of the belief that those levels will be hit in relatively short order. I'm not saying it has to be in the next day or two. When I say short order, I don't mean months away. I mean, between days to weeks. But that's not to say we can't pull back. Any pullback could be a buying opportunity in the gold market, depending on what type of vehicle you play. If you play gold futures, you have to be careful because there's a tremendous amount of leverage when you play the futures markets. But if you're buying the GLDs or the DGPs or any of the other vehicles, the leveraged ETFs or exchange-traded products, I should say, you can begin to scale into those on a pullback in gold. I would be comfortable purchasing when gold futures came back to, if it came back to 1120, 1118, that to me would be a buying territory. Anything below 1110, and I think something else is developing. But I think there's higher prices coming, so I'm just giving you my thought process. And this is in an uptrend. This is a bullish pattern. This was a up move, a pullback, another up move. It's not out of the realm of possibility to see another pullback and then another up move. That's the way markets trade. They trade in waves, and nothing goes in a straight line ever. So what happens is we see an up move and then a pullback, scare everybody away. Another up move and a pullback. Another up move, maybe a pullback. Another up move and a pullback. That's the way markets trade. Nothing goes in a straight line. Each and every time something pulls back, there's reason to believe that it's going to continue on the downside. But pullbacks are healthy, and when markets pull back, they generally pull back in in a mathematical format where I can identify, and a lot of the members that have been around here for a long time can do the same, identify where that pullback should stop. And when it goes through those pullbacks, we know something else could be developing, but we also know what the next level is. And that's the way the markets trade. They trade based on mathematical levels. Silver. Silver was just down slightly today. Again, it's a much more, I want to say, use the term sloppy pattern than gold. It's not in the same type of uptrend as gold, although it is in a bullish position. Although on a very, very short-term basis, I would say that silver probably wants to come down and test the moving averages. And if that's the case, you'll see it down here in this zone, down here at about 1410, 1412, in that neighborhood. It may not close down there, but it looks to me like it wants to test that area. There's a lot of support in that zone. I wouldn't be surprised if it came down and tested that area, pardon me. But it's still in a bullish position as long as it stays above those moving averages. But it's not a very descript pattern, and it's nothing that I can definitively say. It's, the pattern is telling me this. I don't see that in silver. It's very sloppy. It's just back and forth. And you can see here, it's just back and forth, back and forth. Here's a good up move, and it put it in a bullish position above the moving averages, came back to test it, and we could see an ensuing move higher, but this has me a little concerned. This move here, where we had a big down day, and now we're putting in a wedge pattern, and normally this will result in one more move down, and in this case, to the moving averages is what I see. Okay. What do we have next is crude oil. Crude oil got thumped again, 6%. It's just a tough market to trade one way or the other. Long term, lower prices coming. Short term, I thought we were going to be able to squeak out higher prices. That wasn't the case. We hit the first target of 34.75, and that was all she wrote on this move. This is pretty much a rally. This is pretty much a market, crude oil is, where you can almost definitively, and I don't use that type of term very often, specifically with the markets, because you never know exactly what's going to happen. This is a probabilities business. And what I try and do is give you the highest probability scenario that I can. But you can almost definitively say that you will be successful by selling all the rips in crude oil. So any rally can be sold. I wouldn't do it all at once. And if you want to be short crude oil, I would wait for rallies and I would begin to scale in on some, however you want to play it is up to you. I'm not going to put out an official trade alert like this, but this is for the folks, and I know they're out there. I know who you are. This is for the folks that want to be short crude oil and are always looking for a spot to be short. And it's fine, because over the long term, price will be going lower. You're going to see rallies along the way, and the next time the market rallies, you may see a $3, $4, $5 rally in crude oil. That will be an opportunity to sell. Try not to sell at lows. It's very difficult. You're usually wrong initially, and it feels really bad. But almost definitively, every single rally can be sold in crude oil, and that's basically been the case for a year or more. I don't even remember when. If we look back on a weekly chart, the market topped out in July of 2014 and has been perpetually down since. So it's a year and a half, or a little bit more than a year and a half, or about a year and a half, that crude oil has been in a perpetual downtrend. And you can see on the weekly chart, we're below all the moving averages. There's nothing telling me that crude oil is going to rally anything of substance anytime soon. So with any rally in crude oil, you can begin to sell the rips. You kind of have my blessing on that one. You still may get to $38, and that's fine. That would be a phenomenal shorting opportunity. If you short at 34, 35, 36, 37, 38, as long as you do a little at a time, and even if you don't make it up to 38 and you're short with half a position by the time it goes back down, you're still on the correct side of the trade. There's nothing wrong with that. It's a difficult market to trade, but it's a sell the rips type of market, and it's been like that for a long time. Okay, let's go to the bond market because there's more interesting stuff in the bond market. That's the wrong chart. Let me go to the daily chart. And if I can get there, bear with me. Okay, so what happened today is we pierced through the top end of the channel. Now, there's two things that you can glean from this move. A, it's going to be a breakout to new heights, which is very possible. Okay, it's not a short here. There's nothing to short here. So I want to make that clear. There's no signal. There's no reason to be short the bond market at this point in time, even though it's at extreme highs. Okay, but there's nothing to short. Is it likely to pull back? Yes. Are we likely to stay above that top end of that channel for a long time? Probably not. But you don't short highs until you get a signal, okay? So is this an exhaustion move? And that's one way to look at this. A day like today where the bond market was up almost 2%, which is an enormous move for the bond market. And you can tell it's an enormous move by just looking at the size of today's candle. All right, look at the range of today's candle. It's an enormous move, and you have a difficult time finding a candle like this, other than this one here, okay, on the bond chart. Now, was this the end of a move? Well, yeah, it pretty much was. Will this be the end of the move? It may be. But being that we broke out above the channel and we don't have any signal whatsoever, such as a reversal candle, this wasn't on extreme volume today in the Treasury market. So I wouldn't be shorting this market, but I am looking for it to get back inside the channel. Normally, that's what will take place. But the high today was 163.17. In my book, there's almost no chance that we don't go to 164. That's just the way I'm looking at it. It almost has to happen. So, and I'm not suggesting that's going to be the top, but the more extended we get, the more interested I will get in a short trade. And when you look at the flip side of this, and you just think about it logically, let's look at the yields. Yields are going to come down to double bottom, okay? Double bottom is 2.624, okay? Is that the number? I just want to be exact. 2.625, pardon me. All right, so we're not there yet. That's another, 50 basis points away, give or take. That's a big move in the bond market. And the fact that we've cracked this low here, okay, in this zone right here, and we're headed there, we don't all have to get there at once, and nothing moves in a straight line just like every other market. But the odds of us getting down to this double bottom area just increased significantly. So I don't want to short the bond market when I believe that yields will probably test double bottom. So on the 10-year, which many of the market participants follow, we're below that level. Now, what does that tell us? I know the chart just moved on you a little bit, but I hit something, I paused the video, hit something, and something got messed up, and I'll have to adjust it later. But nevertheless, what does this tell us is, in short, it tells us that the bond market is explaining to us in no uncertain terms that the Federal Reserve is not going to be able to do what they think they're going to be able to do, which is normalize interest rates in their mind. They believe that the economy is going to be fine, at least from a public statement perspective. They probably don't actually believe that. I'm sure that they're well aware of what's going on in terms of us being in a deflationary zone, or we're in a deflationary period of time where what that means is asset prices deflate. That means that the bond market is telling us that the Federal Reserve isn't going to be able to raise interest rates any longer, and the likely next move is going to be a take back of the rate increase that they had in December. Now, That's what the bond market is telling us now. The bond market participants are much more savvy investors than the stock market participants. Generally, the stock market participants are more Pollyanna than anything else. They're pretend investors. They always want to believe that everything's going to be fine, and the market, trades based on earnings and price to earnings ratios and all that nonsense. That's not the case. But the bond market participants are savvy investors, and what they're telling us today is that the Federal Reserve is in a pickle, and it's going to stay that way, and the stock market is most likely going lower. That's what the bond market is telling us. Now, again, nothing moves in a straight line. Nothing happens overnight. It's foretelling of what's coming in the future. That's what I'm saying. So I thought the bond market action today was very, very telling. And just to kind of bring that up one more time, it was very interesting nonetheless. Okay, let's go to the dollar. The dollar was down slightly. We're now back to the bottom end of the channel. And until and unless we break below this channel, it's just going to remain going back and forth, back and forth. There's really not much to discuss. Everybody that's been around here for a while understands I'm looking for this level and I'm looking for this level. And most likely we're going to break down from this long-term bearish wedge pattern like this. And once that happens, we can satisfy my downside targets, and then the market can ensue its upward momentum. And that's really all we need to discuss in the dollar. Each and every day, it's the same routine. I know you're getting tired of hearing about it. Other than that, I think that's about all I've got tonight. We're going to leave it there tonight. So as it stands, I'm David Frost, My Strategic Forecast. And thanks for tuning in for another episode of Common Sense Market Analysis.